corrected, because it's true, Cathie, you provided exposure to the crypto world, to Bitcoin in particular, in your offering a couple of years ago. Maybe you can share just your perspective on what you were thinking then and now. What might that change? Might that adjust?
Yes, actually, we gained, or our clients gained, their first exposure to Bitcoin in 2015 when it was about $250. We could gain exposure only one way, and it was through GBTC. We were able to put that security into our ETFs, and we've held. Where we could, I can talk about how ETFs and 40 Act funds treated GBTC, but I think the important point about Bitcoin is back then it was only a $6 billion market cap. It has scaled in the last 5-6 years to nearly $1 trillion in market cap. Back then, therefore, there was really not the liquidity for an ETF. We are now moving into what I believe will be prime time. And I think helping it along is the demand from institutional investors. We've done a study, it's on our website, ARK Invest, Yassine El-Mandra, about institutional participation in this space.
We interviewed him, by the way.
I think we did a million Monte Carlo simulations and came up with if institutions use that kind of analysis where they maybe want to minimize the volatility, or on the other extreme, maximize the Sharpe ratio, they probably should put something between 2.5% and 6.5% of Bitcoin in their portfolios. And the reason is that the correlation of returns to other asset classes is extremely low. In fact, according to our analysis, the highest correlation is to real estate, 0.34. And so it's what every asset allocator seeks, non-correlated assets. And we do believe this is the first new asset class, truly new asset class since the 1600s, since equities. So we're pretty excited about it. I think the most surprising development recently, and we didn't expect it when we wrote our institutional report, is that companies are now diversifying their cash with Bitcoin. We've seen Square do this, Tesla do it, MicroStrategy's it's defining its business around it now. And one of the reasons, as Tesla announced yesterday, is it would like to do business in Bitcoin in regions of the world, well, anywhere, but especially regions of the world where the conversion from fiat, from one fiat to another, is prohibitively expensive. So that's been a surprise to us. And if we add all of the potential demand relative to the limited supply, we come up with incredible numbers over the long term. We have just begun. $1 trillion is nothing compared to where this ultimately will be.
Wow.
It's a strong statement, and I find it fascinating. To buy my next Tesla with Bitcoin would be quite fun and interesting in terms of making that type of transaction. I remember well over a year ago, I was at the New York Boat Show, and Buster's Marine had put up a big sign, "We accept Bitcoin for our boats." I'm not sure how many boats they sold with Bitcoin, but I wonder what those Bitcoin holders are thinking today now, over a year later. They should have held on to it.
I just want to add one thing there. The IRS has something to say about this. So if you have huge gains in your Bitcoin, I don't think I would be very much in the way of transactions until we get maybe some changes on the tax front.
Yeah, very good point. Very good point. I also just wanted to mention too, let me turn it over to Kevin. Kevin, you recently took back the fact that you felt, this asset class is garbage. And, many people resonated, that certainly resonated with many people. And in your comments earlier, just in your introductory comments, you mentioned, rebalancing your family's portfolio. Tell us why you shifted gears.
Well, I live in obviously, as my cohorts do here, in a highly regulated environment. O-Shares has a mandate for quality and preservation. It's used in many family trusts and pensions and institutions that are looking for a way of protecting downside. And so I take a lot of direction from their guidance on the kind of indexes we look to develop in the future. And Bitcoin was not one of them for one singular reason, that regulators globally were not on board. Now, when facts change, I change, and facts have changed. Regulators in Switzerland and France and Australia, New Zealand, Canada have all decided to take a more relaxed stance and view this as a potential new asset class. And so the question is now for most institutions, how do you want to participate? In what way? Do you want to have a situation where you're allocating a certain percentage or not? So that's the binary decision. Yes or no, in or out. That's number one. Number two is a new problem that I think a lot of people haven't considered, and that is this coin compliant with committees? And the real issue there is around compliance on sustainability and compliance around other issues, such as, is this coin manufactured in countries that are abusing human rights or have sanctions against them? And I'm really speaking now of China. I've had many institutions tell me they do not want to own China coin. And as a result, that's going to be a problem going forward, because the majority of coin is mined in China. So I'm spending a fair amount of my time these days trying to deal with miners that are willing to mine compliantly, not just for me, but other institutions that are really interested in owning a coin that have some kind of provenance to them. And so this is a new twist, and the only reason it's emerging is that the majority of institutions do not play in this asset class. I mean, it's exciting that some are coming in, but even at $1 trillion, it's tiny. If it's going to grow, it's going to be because it becomes compliant to ethics committees and sustainability committees. And so every miner I'm talking to now, because my strategy has been, as most people know that have owned Bitcoin, that you can tell the time of creation, but you cannot tell the location of creation. And if in fact you don't want to own China coin, or as now it's being called blood coin, which sounds a lot like blood diamonds, you're going to have to prove the provenance of where your coin was born, so to speak. And that means virgin coin, I think, over time, will take a premium over widely distributed or coins that you don't know the provenance, including ones held in ETFs. It could be a challenge. I believe that ETFs will start to say these coins are known coins, mined in compliant countries, and these are not, or these coins are mined sustainably. So we've got a really interesting issue brewing here. I've been talking to miners. In fact, just before I came on here, I was on with another one, looking for capital, because they're finding out pretty quickly when they go to institutions to expand their operations, they're getting the compliance question I'm raising right now. How are you mining this? Are you using hydroelectricity? Are you burning coal? Where is the geography of your locations? How can you prove to us that what you're doing is compliant around what our standards are? Now, this is a whole new twist to this asset class, because the complexity of mining coin will only go up. And of course, you need a lot of processing power. Right now, the equipment is at a premium.
This is an interesting argument.
I've met manufacturers, if you want to call miners that have production costs as low as $5,500 USD, and others that are at $20,000. So it really determines on the volatility which of these is going to survive. But the amount of capital available for sustained mining is much higher. My strategy is simple. I'm going to partner with institutions, the ones that have come to me after talking about this. I'm going to buy positions in mines. I'm going to take a royalty off their production and know with certainty that my partners' coins are virgin and compliant. And I believe over time I will be paid a premium for those, and I'm not planning to trade them. To me, it's property. It's no different than real estate. You either believe in it or you don't. My current allocation is 3%.
Nice. Nailed it.
I think there's, Laura, I think this ESG issue is becoming a major issue for Bitcoin. There's a good Cambridge University study, though, that shows that 75% of miners use renewable energy, and of the total use of energy for authentication, or people call it mining, I call it authentication. Just about under 40% of their energy comes from renewable sources. There's a public company called Riot Blockchain that uses only renewable energy, I believe, in New York State.
Shout out.
So I think Kevin's identified an issue, and I think some people will use it to slow adoption. But I just wanted to point out those statistics. It's interesting, the standards that are applied to the Bitcoin and crypto world are not necessarily applied to other industries.
Yeah, I'll just add one more on the ESG front, because I know that Treasury Secretary Janet Yellen has focused on the environmental impact. So Yassine El-Mandra, our analyst, did a study and compared Bitcoin mining to gold mining, because Bitcoin's primary use right now is digital gold, and showed that the energy consumption associated with Bitcoin mining is a fraction of that for gold mining. And then when you broaden out the energy use by the entire financial services community, if DeFi, decentralized finance, is what we are talking about here, the energy consumption is, I think, a decimal point relative to that.